So if the Fed is going to continue to hike rates higher for longer, then as you're saying, Michael, we have a slowing economy here. If the Fed is hiking higher for longer, it's pumping the brakes even further on economic growth, and we already have 2 contracting quarters of economic growth behind us, and not a lot of positivity going forward here. So this is sort of, in some ways, sort of the famous policy mistake that people are talking about, which is the Fed may be accelerating the slowing of the economy, as the economy already is organically heading into a recession. Sounds like a pretty bad recession from what you're saying, but I'm assuming if the Fed is hiking rates higher for longer, it's only going to make that bad recession even worse. Is that how you're looking at this?
That's exactly how I'm looking at this. Let's look at one more piece of evidence of the fact that the labor market is very weak. How many times have you heard a high-profile corporation come out and say either A, we've stopped hiring, there's a hiring freeze, or we're engaged in layoffs? There's some, I can't list them all off the top of my head, but there's some very high-profile corporations who have indicated that they are now in the process of shedding workers and have stopped hiring. So
just to answer your question, I can rattle a lot off because I tweet about this almost every day.
Well, you want to throw a few out there? Amazon, Google,
yeah.
Apple?
Well, I mean, so again, it's almost hard to pick a company that either has a big company that either hasn't implemented a hiring freeze or is already in the layoff phase, and a surprising number of big names are already in the layoff phase. Groupon, Snap are the 2 latest that just announced this morning. Amazon is a big one. I'll just mention because you threw it out there, because Amazon has laid off 100,000 workers in the past quarter. And it's almost kind of like on a stealth radar. Like, I haven't seen this picked up all that much by the media, but 100,000 workers in one single company is tremendous, right? And this is at the early part here, when in past videos, I've sort of compared to where we may be in the recession, at least from a job loss standpoint, kind of like you live in Florida, kind of like a hurricane hitting, right? Where before the hurricane arrives in force, the skies darken, you get a little bit of drizzle of rain, the wind begins to pick up. That's kind of the stage we're at right now, I think, and I'm curious to get your sense. Like, I don't think the force of the hurricane has really hit at all yet. And to your point, when it does hit, it's going to make whatever today's pain look like a micro wound.
So the conspiracy theorist in me, it's a small part of me, but not a large part. I have to say, well, where does this number come from? I mean, they're just making this up. Birth death model, you pick it, but is it a political thing to help the Democrats in the fall? And then I said, well, wait a second, that doesn't make any sense, because like we just talked about, this is going to cause Powell to really keep his foot on the brake pedal. Even regardless of who cares if we have peak inflation? As I said, peak inflation is not important. If it was CPI at 3% year over year going to 2.5%, that would be important, or even 5 to 4. But 9 to 8, with over 500,000 net new jobs created, that's going to keep Powell's foot right on that brake pedal, regardless if inflation peaked or not. And when you talk about the economy, let's talk about what the Fed has done so far. The Fed started hiking rates in March of 2022. They're at 0 to 25 basis points. So from March of 2022 to the end of this year, we are going to have a effective Fed funds rate of 3.3%. Conservatively, in my opinion, and in the opinion of many others, including the dot plot. Okay? Summary of economic projections that the Fed publishes. You're going from 0 to 3.3%. And in a rate of change world where I live in calculus, that's the fastest rate of change that we've ever seen a Federal Reserve hike rates.
Right.
And monetary policy, Adam, as you know, not telling you anything you don't know, works with a lag. So what effect has the higher borrowing cost had on the economy? Not much yet, only tangentially and incipient and insidiously. Not only that, and I have heard nobody mention this, but I went back and, I did have a drink before I did this, because I couldn't take it without having one glass of Brunello.
Oh, well, nice.
When I went back and listened to the entire press conference from Jerome Powell, and nobody is really talking about this, but he had one question. I think it was the 30 or 31st minute of the press conference. He had one lousy question about the balance sheet. And I would encourage everybody to listen to my podcast on Wednesday. I record it, where I'm going to pull some verbiage analysis of the balance sheet and why it's reticent to shrink. And I'm gonna comment on that on Wednesday evening when I record my podcast, midweek reality check. Powell said this. He was asked about the balance sheet, and he said, well, the balance sheet started slowly because of some trade settling. And in my podcast, I'll talk about what he means when he says trades take some time to settle. Basically, the Fed buys a bunch of mortgage-backed securities, puts them on the balance sheet, but they don't record that trade as being part of their balance sheet for like 3 months in arrears. I don't know why. That's what they do. But then he said this. As I was drinking my Brunello, I said, I got to replay that. He said that the balance sheet will take, you ready for this? 2 to 2.5 years before it reaches reconciliation, before it becomes in balance, before it normalizes. And I said to myself, Powell is now admitting that QT started slowly, and it did. It barely shrank. In fact, through most of the month of July, it actually increased.
Right.
What's going on here? It's supposed to shrink by 47 billion. Starting September, it's $95 billion a month, and that pace of balance sheet reduction is supposed to last for 2 to 2.5 years, right out of the man's mouth. So, in conclusion, this drives me nuts when people talk about a Powell pivot. Pivot to what? Pivot to 50 basis point rate hikes? He's going to have the Fed funds rate, effective Fed funds rate at 3 and 3.3% at a minimum the end of this year, and will have drained a $500 billion out of the base money supply. Yes, Fed credit is money. Let's make no mistake about that. I heard some interviews where people were trying to claim that the size of the balance sheet is irrelevant. That is so wrong. The base money supply is physical currency, coins and paper money in circulation, and Fed credit. Why is that called high-powered money? Because credit is what they use to make loans. Every loan has to have a reserve. Reserves are credit. And credit is used to buy stocks, bonds, and make loans. So it is money. They're going to burn $500 billion of that by the end of this year. Between me having this interview and the end of this year is going to have the most destructive part of the eye wall of that hurricane that Jamie Dimon has said is spinning offshore. It's going to hit, and that is going to break the credit markets. And that's when the steepest decline of the economic growth and earnings and stock market returns will be.
All right, great.
Sorry for that rant. Sorry.
No. Well, it was very instructive, and it answered the question I was heading towards, which was using the hurricane analogy. When do you think this recession is really going to be in full force? Where are we going to see the impact of the current Fed tightening policy? And you're basically saying by the end of this year, we should really be feeling it.
It will be undeniable.
If you enjoyed this video clip, click here to watch another one you should like.